Hi everybody, Joe Conroy, financial advisor with Hartford Retirement Planners. If you watch the news lately, you've seen a lot of scary things geopolitically, and certainly the market more and more has been in the headlines, but not for the right reasons. And it's been frustrating. So just as a quick recap, 2020, of course, COVID came on the scene, the market had a huge reaction to it, and then almost as quickly it rebounded. So if you didn't make any mistakes, like most of our clients didn't, you had a relatively brief period, but a good year. 2021, really not much downside at all. The first half of the year had tremendous growth, slowed down a little bit, but still headed in the right direction towards the second half, which brings us to 2022. How frustrating is 2022? It seems like we just can't get anything going. Not many good months balancing out, so we're in negative market territory. It's frustrating. I'm frustrated, believe me. So let's talk about that, right? Because I know a lot of folks watching this video are at or in retirement, and you're thinking, I don't have a whole lot of years left, Joe, in order to earn all this money back. I also think most people watching this do agree that the market has better days ahead for us. We just have to get to that point. So if you're at retirement or in retirement, what I'll say to you is retirement, hopefully for you, is going to last several decades. So even though you might not feel like a short-term investor, you're a little bit more longer-term than you might give yourself credit for. And if you're in your 50s or below, then you look at this temporary market downturn as a gift. Because what we do know as investors is we're always looking forward, which is hard to do sometimes, especially when the headlines are so loud and so strong right now. But going forward, do you think there are better days ahead in the market? And if you do, like hopefully everybody watching this video is, then we get excited about these downturns if we're still climbing that wealth mountain and we're accumulating. And if we're at the top of the mountain, we're taking distributions. Like I mentioned earlier, we need to maintain that we still are long-term investors, even though it might not feel like it. So what we don't want to do is make decisions based on emotions, right? Whenever you make a knee-jerk reaction or an emotional decision, especially when it turns to money, usually they kind of work out not in your best interest. So some of the things I think we're going to hear is more of the R word, recession, right? That's a scary word. You had the Great Recession of 2008. I don't think this is going to be that. Very low likelihood. Most on Wall Street would agree. But a recession is a scary word nonetheless. And what is a recession? It's defined as 2 negative quarters of GDP growth, right? Negative growth sounds really bad, but negative growth could be negative 1%, negative 0.5%. GDP has been really strong these last couple of years. So what we're really talking about is maybe not a complete downturn, but just kind of a slowing period where maybe we have some slight negative GDP contraction, a mild recession. Now, that R word is going to have less seasoned investors than those watching this hitting the panic button. And they're always going to wonder why they can't make money in the market. But we know that we need to think long term, and where the market is today doesn't mean that that's where it's going to be in 6 months or a year from now or whenever that recovery happens. We also know that the markets are very forward looking, so if the news is anticipated to be bad, the markets are going to trade it now instead of waiting for an actual recession. It's very conceivable that by the time it's actually an official recession, if that even is the case, the market's 6 months to 9 months ahead of it. And what happens after a recession? Growth, right? So what's trading now is on some bad headlines and the anticipation of what might be for the future. And if anything falls short in terms of not being as bad as we make it out to be, we might see this rubber band, which up until the beginning of this year was on the upside. Well, it snapped back downwards, and once we know that we hit that rubber band down as low as it will go, what happens next? It snaps back up. And that trend line of growth, what we see in our average returns over 5-10-year rolling time frames, that's what the equilibrium is. And any month or 6 months or quarter, we're going to see that rubber band bounce a little bit. So should you be concerned? Concern's not a bad thing, but we shouldn't be panicked. We shouldn't lose focus of our long-term goals and how our investments are also configured long-term into those goals. Sometimes steady as she goes, and if you have any extra money, or maybe we have a little bit more in bonds and we can afford to wait on the money a little bit, rebalancing into stocks might not be a bad idea right now. So if you have concern, or even if you are panicked about this, give us a call. We want to talk you through it and try to make sense of this as best we can. Or if you just want to call and air your frustrations, it would not be falling on deaf ears. We would like to hear that, and we probably have a little frustration with this market that we could share with you too. But we will get there. Every storm runs out of rain eventually. It was a super rainy weekend here around Baltimore where we're recording this. And what I can tell you is I stepped out today. Today's Monday that we're recording. I looked out, the sky was as blue as I've seen it all year long. There are blue skies ahead for us. The rain will stop. The storm in the market will be over and we'll be fine. And we're here for you. If you want to talk it through, give us a call. As always, thank you for watching.